Hey guys, welcome and welcome back to my channel once again. This is your friend Abhishek, but not a financial advisor. And today's topic is a top dividend growth stock, of course, in my opinion. And this is, like I said, is not any financial advice. You should be doing your own due diligence, but let's just cut to the chase. So guys, the dividend stock which we are going to talk about, which has a huge growth potential and of course plus is giving quite a decent amount of dividend, which is more than decent to be honest in my opinion, and which is in my portfolio since 2-3 months. So I would say that I have recently added this to my portfolio, and of course I have shared this with my patrons as well. So the name of the company is Enterprise Product Partners. And now, Enterprise Product Partners is one of the largest midstream oil and gas stocks in the US, with nearly 50,000 miles of pipelines transporting natural gas liquids, crude oil, and petrochemicals, and other refined products as well. Enterprise Products Partners stores, processes, and transport fuels and is also the world's largest exporter of liquefied petroleum gas, which is LPG. And with the prices of the oil and gas rising, Enterprise Product Partners generated nearly 2 billion in cash from operations during its second quarter, which is up by 69% year over year, and it has generated 1.6 billion dollars in distributable cash flow that comfortably covered its distribution or dividend by 1.6 times. And this is, guys, one of the most important things in my opinion when we are looking in for a dividend producing company, which simply means that how much capital they are returning to their investors in the form of dividends from their cash flow, free cash flow, which is also known as free cash flow payout ratio. Now, this payout ratio could be calculated also with respect to earnings or revenue, but I personally don't look into the payout ratio with respect to earnings or revenue, because for me, the free cash flow is the ultimate guideline, because this cannot be manipulated, and the bottom line of the cash flow statement is that's it, that cannot be manipulated, and that much money the company is able to generate in the form of free cash, and they have this much money to either invest back into the business or to give it out for their investors. Now, if this payout ratio is anywhere between or more than 80-90%, then that is a red flag for me. For many other investors, that could be good because they think that, okay, the company is giving out money to their investors, they are thinking about their investors, but no, that's not how I am thinking. If the company is giving out all their money back to the investors, then that means they are not putting any money from their cash flow, from their profitability back into the business to grow their business, which for me is quite important because I am buying a business. I'm not buying a business just because they are giving out so much money to me. And in case of what happened last 2 years, pandemic occurred, and in that case they would of course have to cut out on their dividends because they would need money to survive. And that is why high percentage of payout ratios is also not very good. It's just not good. Yeah, that's why when people are talking about higher yields of dividend like 6 or 7%, usually they are thinking about such high payout ratios. That means the company might be giving out a high amount of money back to their investors and not investing back into the business, or in case of some bad times, then the company must cut out on their dividends, or they would have to take extra debt to continue to give out such high yield dividends. That's why we have to look at the payout ratio as well, and yeah, we will get on to that as well. And there are many other reasons, guys, why I have invested into this company, not just as a reason of dividend investing, but also because I believe in this company. And I do see fundamental wise, this company is quite strong. And seeing the future for this company, I do see that this company has a huge growth potential as well. Now, yeah, I do know that yeah, we are moving towards environmental friendly conditions and we are moving towards EV industry, and that might raise a question in everybody's mind, then why some investors are still investing into oil and gas industry? Well, because the demand in the oil and natural gas is not going to slow down whatsoever, guys, and we will get onto this point in a few moments as well. But I just want to point out that also why the price of the stock actually shooted. Yeah, as you can see, since 5 days the price is rising. This is because on Monday morning the crude oil prices surged and hit the 7-year highs after the Organization of Petroleum Exporting Countries, which comes under OPEC, and its allies decided to continue with earlier plans to increase oil production. only gradually each month instead of ramping it up now. So you see that there are plans in increase of oil production, and OPC made this decision despite calls from some key oil consuming nations to boost production in the wake of soaring global demand and the energy crisis in Europe especially, and natural gas prices too inched higher Monday to hit multi-year highs. And that's why the most oil and gas stocks were soaring, and of course Enterprise Product Partners was also joining this rally. Now we can think that this is, let's say, short term, yeah. According to this point, you might say, you might have a question in your mind that this is just short term, but let me show you this point which I said we will come on to. Are the oil prices, crude oil prices, in future? Okay, so you can see these projections. These are long-term crude oil projections until 2050, and you can see there are no signs in the reduction in demand of oil and natural gas, and the prices are just going to rise and rise and rise. So you can see that this projection is until 2050 and it starts all the way from 2021. So this is also one of the points why I am interested in this company, because guys, here we are buying a whole business. We are not just buying the company for the sake of dividends. We want our capital to rise as well. That means we want the stock price to rise also with time eventually. Of course there will be up and downs, but in long term we should see our capital to rise. And why I'm saying again and again that we are buying the whole business, because like Warren Buffett says that we should be thinking about buying the whole business, not just a stock. And when we are thinking about buying a business, we should be thinking in long term. We should be thinking the long term prospects of the business, how the company is going to generate its revenue, what are the ways the company could generate its revenue, how the company is going to generate its cash flow. And that is what we are talking about here. Of course, all these are speculations, all these are just projections, but that's all what we can do. Every investor can only assume for long term based on the data presented to the investor. And here we can see that in long term, the company has huge growth potential, because the demand, the market which the company is in, that market is not going to slow down. And that's what have made me interested in this company. And this is again another bullish point, and why I think that this is a top dividend growth stock in my opinion. But this is what tells us that the business is not going to suffer in the future from the market point of view. Okay, and this is what I wanted to show you, so we can see that the business will sustain. Now let's move on. So guys, now one of the most important points, which from an investing point of view is quite important regardless if it's a dividend paying company or not, which is how the business is generating its revenue and if its revenue is going to be stable in the future. Because if the revenue is going to be stable in the future, then they can generate enough cash, and if they have enough cash, then of course they have a positive cash flow, and then only they can pay out their dividends from their cash, and they don't have to take a lot of debt, which many companies are doing just to attract their investors to pay out dividends. Okay, and of course, when the company is profitable and have enough cash, this makes us more comfortable, and they would not have to cut on their dividends, which we have seen in the past years, especially during pandemic, when the businesses were not generating enough revenue. They had to cut on their dividends because they were having enough debt to just run their operations. Okay, so let's see how they are actually generating their revenues and how stable these revenue streams are. So their revenue is mostly coming in the form of long-term fixed fee or take or pay contracts, which let the midstream operator get paid regardless of whether its customers accept the delivery of the product or not. These contracts make for a very stable revenue stream and offers, of course, predictable cash flows. Yeah, and of course, which has allowed Enterprise to raise its dividend for 22 consecutive years. And this is a really good point for me, guys, and this is what makes me more confident for investing into this company. So like I showed you, that this is not just a dividend company, this has a huge growth potential. So your capital will be rising with this company if you are invested into this company, plus you get the dividend as a bonus. Yeah, and by the way, now coming on to one of the most important point, which is how much dividend they are paying. So Enterprise Product Partners, ticker symbol EPD, pays out a dividend yield of whopping 7.79%, guys. That is the dividend yield. Now I know many of you might be thinking, hey, but 5% dividend yield is secure and safe and this and that. Well, let me show you again. So here we are, we have a cash flow payout ratio for enterprise product partners of just 58%, which in my opinion is safe. Yes, it is safe. And of course we will go on to fundamentals again shortly. This is not in-depth video, but we will cover the fundamentals to show you guys that this company is fundamentally strong. So now let's just jump onto the fundamentals quickly. So for the fundamentals, we will just cover it quickly, and to cover it quickly, we will just look at some of the key ratios, which will also tell us the stability of the business and how healthy the business is from the numbers point of view. Okay, so the trailing PE ratio is just sitting at 13, and the forward PE ratio is just at 10, which is amazing in my opinion, quite cheap. And the price to sales ratio is also 1 at 1.58, and price to book value is sitting at 2.07. Now the most important thing from my point of view while buying a business are the business margins. So we can see that their profit margin is at 11.81%, and their operating gross margin is at 17.66%. So operating margin in my opinion is still okay, but the gross margin could have been better in my opinion. 15% is a good margin, yeah, but it's not bad. The business is making and generating profit, and the return on equity is also at 15.27%, which again in my opinion is not that bad at all. Okay guys, so now let's have a quick look at its balance sheet to see how balanced the business is with respect to its assets and liabilities. So going on to the financials and then the balance sheet. So here we are. So the total assets are sitting at $64 billion, and then the total liabilities are sitting at $38 billion. The current assets are sitting at $9 billion, and the current liabilities are sitting at approximately $9 billion. So yeah, the current ratio is still over 1, which is still good. Could have been better, but okay. And we can see that the total assets are increasing over the years, and the total liabilities are also increasing on the other hand over the years. It's okay until unless the total assets always exceeds the total liabilities and the current ratio is higher than 1. It's good. Now of course this is not the best balance sheet I would say, but still we can see that the business is safe. The business is financially safe. It's not going anywhere. Now yeah, one thing to be considered is that guys, this is not from the trailing 12-month period, so the latest data could be changed, but I don't think that there could be a big change in the trailing 12-month period data. We can always look at their quarterly reports, so have a look at that. Again, anyways, you should be doing your own due diligence. This is not any kind of a financial advice, so I'm just giving out the data what we can see right here. So like we can see, yes, the business is okay. It is not the best balance sheet like I said, but the business is financially stable. And this is just like a cherry on the cake, which also gives me a bit of more confidence in enterprise product partners. So not just me, but also the billionaire Leon Cooperman actually has a stake value of over $12 million in enterprise product partners. And like I told you guys earlier in this video, that I don't just invest into companies because of their dividends, but I look into the businesses and how is the future of those businesses, how my capital will also grow and not just my dividends. And this shows me, and this gives me one more reason to buy enterprise product partners, because the stock forecast, the price targets for this business is quite good, and we do have a 22% upside potential on the stock price, and it comes with 7 strong buy ratings with no hold and no sell ratings, and we have an average price of $28.86, which is, like I said, 22% upside from the current price. So like I told you guys, there are enough reasons for me at least to buy into this business, and I have done that already, and I'm already up by 6% on this business. And of course I will also be getting my dividends with a 7.8% yield. So I have almost nothing to lose. No, I'm just kidding guys. Every investment has some risk, comes with some risk. So but I'm pretty much happy with investing into this business, and I have given you guys my reasons why I have invested into this business. So please make your own due diligence and don't just rely on my research. And again, this is not any kind of a financial advice guys. I'm just letting you guys know what I have been doing. That's it. So I just wanted to share, and that's all for today. I will see you in the next one guys. Till then, ciao.